In this video, we're going to discuss 5 common situations that create an income gap for federal employees during retirement. That's coming up, so stay tuned. Hi, I'm Jarrell Harvey with Fedway Financial, and this is the Money Briefing. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you're new here, consider subscribing. Figuring out your income in retirement sometimes feels like middle school algebra. We know there's typically 3 sources of income that federal employees withdraw from during retirement: their pension, Social Security, and their TSP, and other investment accounts. But deciding when to start drawing money from those 3 sources and determining how much each source will contribute creates the more challenging equation. This leads to many federal employees and retirees calculating ways to close a gap in which their spending needs exceed their income. There are 5 critical junctures that typically create an income gap for federal employees. The first one is the service separation income gap. This occurs immediately after you retire or separate from federal service. Most federal employees would not receive their first retirement check until 3 months after they retire. The initial checks that you receive will be interim payments, which can be anywhere between 60% and 80% of your final pension amount. You will not receive your full monthly pension until about 6 months after you leave the federal government. And those timelines assume that everything goes well. If there's any issue with your application, it can take much longer to receive your interim payment and full payment. There are also delays that commonly occur during certain periods of the year. On a positive note, when you finally get your first 100% check, you will also receive the difference between your interim payments and the full amount that you should have been paid. Until your interim and full pension payments start, it's important to have cash reserves to help cover living expenses. If you have unused annual leave, it can also help offset the income gap because it is paid out as a lump sum shortly after retirement. Also, retirees should be prepared to adjust from bi-weekly checks to monthly checks, which may require some adjustments in the beginning. The second gap is the special supplement income gap. The first supplement is designed to help bridge the income period between the start of retirement until you become eligible to draw Social Security at age 62. If you qualify for the supplement, it will be included in your monthly check when you start receiving your full pension amount. But the supplement provides significantly less income than most federal employees' Social Security benefit. The supplement is based on your age 62 Social Security payment, but you must retire with 40 years of service to get approximately the same payment amount as your age 62 benefit. The average length of service at retirement for federal employees is roughly 25 years, which means the average retiree will only get about 62.5% of their age 62 Social Security benefit. That difference can create a significant shortfall in income gap. Additionally, the first supplement is not increased by any cost of living adjustment. So whatever your supplement income is when it starts, it'll be that same amount until the supplement ends at age 62. The supplement is also subject to an annual earnings limit, which may affect the payment amount from year to year. Exceeding the earnings limit may significantly reduce or even eliminate your first supplement. The next critical decision point is solving the Social Security income gap. You have the option to start Social Security at any age between 62 and 70. There are advantages and disadvantages of claiming your Social Security early. The obvious advantage is the sooner you claim your benefit, the sooner you can get some form of income. However, Social Security payments are reduced if you claim them before your full retirement age, which is typically age 66 or 67, depending on your birth year. If you sign up at age 62, your Social Security payments will be 25% smaller if your full retirement age is 66, and 30% lower if your full retirement age is 67. Like the first supplement, Social Security is subject to an earnings test if you start Social Security before your full retirement age. On the flip side, there are incentives for those who are willing to wait. Your monthly payments will get larger each month that you delay claiming your benefit. You will get about a 6% to 8% boost to your payment for every year that you delay. But as you wait, you have to fill that gap with some other source of income. The fourth gap that you have to properly plan for is the savings income gap. Your savings may include your TSP, your IRA accounts, and any other liquid assets that can be used to fund your living expenses. Typically, your savings will fill any gap that is not fulfilled between your pension and Social Security. But drawing down your savings too much or too quickly may create a different dilemma. There are some popular income strategies for withdrawing money from your investment accounts, such as the 4% rule, but that strategy may not work for you, depending on your spending needs and your length of retirement. Also, future market conditions and inflation rates could have a big impact on determining how far your savings may stretch. Those who have sufficient sources of income may choose to delay withdrawing from their retirement accounts until they're forced to take required minimum distributions at age 72. If you have the flexibility to go with that option, you still want to do some planning to ensure that your future withdrawals don't create any significant challenges down the road with taxes or Medicare Part B premiums, which are based on your income level. The last income gap that I want to cover is the surviving spouse income gap. If you're married, your spouse is eligible to receive an annuity benefit after you die. Under FERS, the maximum survivor benefit is 50% of your annual pension. Leaving your spouse with a maximum benefit of 50% will reduce your monthly pension payment by 10%, and a partial benefit of 25% will lower your monthly payment by 5%. If you choose to not leave a survivor benefit, there's no reduction to your pension, but half of your benefit, a quarter of your benefit, or no benefit at all could cause a sizable income gap for your spouse. Not leaving a survivor benefit may have other consequences as well. It may negatively affect your spouse's eligibility to continue federal health insurance coverage after you die. Given the rise in healthcare costs as people age, this could have a big impact on a person's cash flow in retirement. Life insurance can definitely help close an income gap left after one's death. But keep in mind, most retirees' federal life insurance coverage begins to significantly reduce at age 65. So private life insurance and other assets may be required to adequately meet your spouse's income needs. There's no doubt that proper income planning is required at all stages of retirement. It's important to assess the potential income gaps caused by service separation, smaller supplement payments, Social Security, savings, and survivor benefits. If you received any value from this video, please click the like button, and I enjoy hearing from you. So drop any responses or questions in the comment section. Thanks for watching, and we'll see you on the next Money Briefing.